Good morning, everybody. Welcome to today's 1 Million by 1 Million Strategy Roundtable for Entrepreneurs. 1M1M, as you know, is the first and only global virtual accelerator in the world. We run it from Silicon Valley, but with a global footprint, and our mission is to help 1 million entrepreneurs reach $1 million in annual revenue and beyond, build $1 trillion in global GDP and 10 million jobs. And in support of this mission, we do these free mentoring sessions every week almost, every Thursday morning. This is our 306th session. It's been going on for years. 1M1M was founded in 2010, and these roundtables actually preceded 1M1M. It is these experiments that led us to the 1M1M format. So, you know, we've had a chance to work with many, many, many of you. We've had over 50,000 people here over time. And the event is being recorded. You will have the recording available on our blog and on the YouTube channel. If you're live tweeting the show today, please use hashtag 1M1M. And our Twitter handles are at 1M by 1M and at Romana. We publish a lot of rich, interesting content there. The YouTube channel is 1M1M Roundtables. All prior session recordings are available there, so please feel free to look those up. A lot of learning available for free through those sessions. Now, we will have Q&A. I'm not quite ready to open up the line yet, but do make a note of the phone numbers, and we will put the slide back up when we are ready for your call-ins and questions and discussions. But we do want you to participate, that's for sure. This is a roundtable. It's not a broadcast. This is a roundtable, and we want all of you to participate as much as possible through phone or chat. We are going to start today with John Dougery, co-founder and managing director at Inventus Capital. Inventus has been very active in the India-US corridor for some years, and we invited John today to get to know, what is the evolution of your firm's investment thesis and so forth. So welcome, John. It's great to have you here.
Well, thank you. Happy to be here.
So tell us a little bit about your firm and what is your thesis? You're a co-founder of the firm, so you must have founded the firm with a certain thesis, and how has it evolved over the years that you've been in action in this corridor?
Yeah, absolutely. This firm is, I guess, one of my entrepreneurial efforts of my own, but along with my co-founders. It all came out of my mutual experience with Conwal Recchi, who some of you may know was, a very successful entrepreneur here in Silicon Valley, the first Indian to emigrate to the U.S., get venture backing and take a company public as a result. And that was way back in the 80s. He was the first to commercialize TCP IP over Ethernet, and had a successful IPO, and ultimately merged it with Novell and ran Novell for 5 years and took Novell to India, actually, in the early 90s, one of the first to move significant engineering into India, cross border with Silicon Valley. And he and I got to know each other in industry. I was in the PC business back in the 80s when I came out of Berkeley, and then in the workstation business with Sun and Silicon Graphics through the early to mid 90s. And then I got recruited into venture capital in 97, and by that time Conwal also had kind of left his operating career and become a big, very prolific angel investor. I guess he was a super angel before that was a coined term. He was investing in 5 to 6 or 7 new companies every year, for about 10 years. And he and I invested in a number of companies together, largely in the Indian community. As a result of our work together, most of the entrepreneurs I backed and that I gravitated towards even through the mid-late 90s and into the noughts were of Indian origin. And he and I kind of sat down in 2004 when the dust had settled after the dot-com, and we kind of compared notes and discussed the fact that we'd seen a lot of success with the lean startup model, which was just becoming a coined term at that time. And we had invested in nearly 80 companies at that point, and we kind of looked at our track records and and realized that most of the wealth for both the entrepreneurs and the investors had come in these companies that hadn't taken huge amounts of capital, and many of them were among the first to, for example, like Nextag, were among the first to start in Silicon Valley, but ultimately build 80–90% of the staff and the engineering and so forth out of India. And so we thought, gee, here we were in 2004. You could see what was happening in China, and you could see the trajectory that China was on as an emerging, entrepreneurial economy. And Cornwall had been extremely engaged with both the Prime Minister at that time, Vajpayee, and others in India, in the late 90s, and helping them basically reform the economy, open up venture capital, open up sectors like telecom to private enterprise, and so he was very engaged and saw that the entrepreneurial ecosystem was emerging there, and we thought, if we're going to start a new venture firm, it's just like starting a company. We should start it in a sector where we have hopefully an unfair advantage, an access to the entrepreneurs, and an information advantage where we understand it better than most. And we decided that a smaller venture capital firm of $50 or $100 million in size, focused on capital-efficient entrepreneurs with the leverage of the emerging Indian opportunity, could be the opportunity to build a new kind of leadership firm in that segment, and so that's what we went out to do. So he and I traveled to India, I guess, probably about a dozen times throughout 2005. We were back and forth, seemed like I was on the plane all the time. And we met hundreds of entrepreneurs, talked to the various venture capitalists that were on the ground at that time, and came to the conclusion that there was still a big opportunity to hopefully build the #1 firm that would focus on the Indian community, regardless of where they are, whether in Silicon Valley or India. And we made a conscious choice that we didn't want to have ourselves be the only ones involved and be commuting to India, so we sought out experienced partners on the ground in India. So our co-founder, Samir Kumar, joined us. Cornwall had known him for probably about 6 years at that point. He'd been a venture capitalist on the ground in Bangalore for that past 6 years with Tech Ventures, ran all their Indian investments. And we went out, raised the fund, which wasn't easy. It was 2007 when we started. It was 2008 when we finished, and obviously it was a very tumultuous time in the capital markets and in venture in general. Venture hadn't produced returns for quite some time at that point in time, and a lot of investors were losing faith. But we found some that believed in us, and we were able to get it off the ground. Our first fund was $50 million. We started investing that in 2008. Expanded our team. We had a fourth partner we brought on, Parag Dole, who again had been one of the first venture capitalists in India. He'd been with ICICI back in 1993, and he'd invested in Indian entrepreneurs across the country for nearly 15 years by the time he joined us. So, we felt like we had the best team. We all had operating backgrounds, and we were very focused on entrepreneurs who were applying technology to basically modernize the economy. There's so many opportunities and inefficiencies, as I'm sure many of you know, in India, but also to build world-class products for business customers out of India or between India and Silicon Valley. So our focus was and continues to be on both consumer consumption in India, but also business consumption both in India and globally. So about half our companies are business software companies with an increasingly heavy dose of services inside them. So it's not just technology, but it can be really high-end advanced services that are combined there, and I can give you several examples. And it's ebbed and flowed a bit. Obviously, India's gone through a huge renaissance in entrepreneurial efforts in the last 2 years. Has been more than a doubling and a tripling of the amount of capital, the number of companies being started, and frankly the quality of companies being started. All of those have improved since we started. So it's kind of playing out as we expected. 2008 made it a little bit slower to emerge than we'd hoped for in the beginning, but directionally we're heading in the direction we expected to head, and we're feeling very optimistic about it. And I think that there's some people are worried about the short-term corrections or valuations, those sorts of things, but those are, in our experience, are the normal cycle. and, unavoidable in venture in any economy, whether it's China, whether it's Silicon Valley. They always go through these cycles, but I think the underlying fundamentals are still very encouraging. So that's we're very focused on that. Yeah.
Let's double-click down on some of the things you've said. Firstly, for our audience is early-stage entrepreneurs, and like you said, we also believe in this capital-efficient entrepreneurship philosophy. By and large, we have tried to coach and mentor our entrepreneurs to focus on that philosophy. Having said that, the last few years, last couple of years especially, have been a bubble market. So in our portfolio, one of the companies has raised $100 million, and we'll see how that all pans out. So far, so good. They're doing great, making tons of getting lots of customers and so forth. So that's all very well. But in general, though, personally, I much prefer companies that don't raise that kind of money and operate with much leaner, tighter principles. So it sounds like that's where your sweet spot is. So tell us a little bit about at what point, from a stage point of view, at what point do you like to invest? What do you like to see as proof point? If you're doing B2C, what do you like to see in terms of traction and validation? If you're doing B2B, what do you like to see so that our entrepreneurs get a feel for when is a good time to start working with you?
Yeah, that's a very good question, and we too have some companies that have raised $100 million or more. We don't have total control over that, and some companies, justify it and can put it to good use. So there are exceptions, but the rule is what you outlined, which is capital efficiency, and we find that to be as much in the entrepreneur's interest as ours. But going to your question for where we focus, we have always been the kind of post-seed Series A investor. Before we started Inventus, and ever since we did start Inventus, our sweet spot, well, there's always, again, exceptions to any rule. Our sweet spot is that lead investor at the Series A stage, which in India, and frankly in the Indian community in Silicon Valley as well, is generally a company that has a product. Maybe it's just a beta product, but it's usually a product that's working, it's in the hands of customers, and so there's some validation that the product works and that it delivers an ROI that a customer is willing to pay for. So it doesn't need to be huge scale. It's not about how many dollars of revenue. It's about how many customers, how much approbation of the value statement in the business plan is present. And then we would lead the first, $2 to $4 million is typically the general range of the size of the Series A round. We would do, anywhere from half of that to 2/3 of that, and we generally like to syndicate. We think that, again, it's in our best interest, but also I think in the company's best interest to have a good foundation of support at that stage. And so we like to have two firms that are with high conviction, willing to put in, at least $1 million or $2 each to support the company and hopefully support the future rounds of the company as it progresses. So that's our style. We found, again, this all came out of our own kind of analysis of what had worked and what hadn't in the past, and we found that where we were making highly convicted bets and, significantly engaged with the teams, that we had wonderful results. We've had over a dozen IPOs, dozens of M&A events, over $30 billion in value created from those type of investments. And, the areas where we followed other people kind of passively, put in a little money here or there, we kind of broke even, and, those companies did okay, but they didn't do great. So no surprise when we formed Inventus, we said, hey, we want to be the lead investor. We don't want to make dozens of investments a year. We want to make 6 or 8 and be highly engaged and very focused. This is just what we coach our entrepreneurs to do, be focused, have high conviction, and so we kind of take our own medicine there.
Let's do a couple of case studies of the kinds of companies that you have invested in, stayed with, and had successes with. And if you could, for the benefit of our entrepreneurs, if you could walk us through the logic and the thought process of what was the investment thesis when you invested, how did it pan out, what did you learn from that, and what can we learn from that?
Sure, sure. Well, I noticed we have a lot of the audience is from India, so I guess I'll start with, we invest in both companies that are based in India as well as those that are headquartered in Silicon Valley, and I can give examples of both. But I guess I'll start with one that was based out of Bangalore. And it's a very typical example of how we work. This is an entrepreneur that actually we started tracking and mentoring, just because we liked him, and we was involved with Thai in Bangalore back in 2006. This is when we were just forming the firm. We didn't have the capital yet, but we were engaged with the community, and we helped him find his seed financing at that time because he was 26-year-old, and he was starting a company called Redbus. And Redbus came out of his own experience trying to get home for the holidays, for Diwali, and he couldn't get there because, the state-of-the-art then for bus travel, which is typically how people get to many cities that aren't served by air or they can't afford it, right, was to go down to the bus depot, stand in line, and hope to find a ticket. And that's what he did. He expected he'd get a ticket. By the time he got to the window, that bus route was sold out, and he couldn't get home. And he was very frustrated by that. That was back in 2004 and 2005. And so he started Redbus to do something that sounds very simple, but actually was very ambitious, which was to put all these bus operators online, put all the inventory in an online form, similar to Make My Trip for air travel or hotels, so that you could discover and book online rather than having to go physically down to the bus depot. Really ambitious because, like so many things in India, a highly, highly fragmented supply. Not like there's a Greyhound that has 60% market share. 1,200 bus operators, and you still do today, none of whom have huge market share. So you have to get hundreds of these bus operators online before you have meaningful inventory. And without meaningful inventory, building a marketplace, consumers don't care. So he had to break that cycle and get meaningful inventory, get the consumers to care. And the innovative thing he did is he built the software that would basically automate the operations for these bus operators, and he gave it to them for free. All the other competitors were trying to charge him for it on a SaaS basis, software as a service basis. He realized, hey, if I can help them move from paper and pencil in a physical register, which is really what it was, what the state-of-the-art was, to automated billing, exposing the inventory to all the other travel agents, the physical travel agents around the country, all for free, then they'll come on my system, they'll expose their inventory in mass, and then consumers will care, and then I'll get my fair share of the ticket sales through my site. And that's exactly how it worked out. We had mentored him and tracked him for 18 months, and then in 2008, late 2008, he was looking for his Series A. He had about 2 million in ticket sales trailing. So he's been selling a good number of tickets, but he had, he's only kind of in the Bangalore region. And, we led the Series A. We syndicated it, brought in another, investor, and it was off to the races. He grew 10x in 4 years to over 100 million of ticket sales 4 years later. He raised a total of $9 million. He'd only used 4 of it. So when he was acquired, which was not something we looked for, we were looking to do an expansion financing, and a strategic investor decided they wanted to buy all the stock instead of some of it. And they gave us a valuation that the entrepreneur was very excited about. And it was a tough decision, but we decided to sell the company. It was a great outcome for him. It was a great outcome for everybody. But again, a very capital-efficient business where he owned a lot in the end. And so that's what made the acquisition so attractive for him and for the rest of us.
So I met Funny, this, by the way, the entrepreneur's name in Redbus is Funny Indrasama. Funny, he goes by. I met him back in 2010, and we did a huge story on him. First in 2011, we've covered the company all along, and he's a great guy, really wonderful person, not just a great entrepreneur. And I think there's a lot. Redbus was one of the first, first companies in the e-commerce model that actually scaled to a large extent. I guess the question that I have out of all of these, Flipkart, Redbus, and all of the e-commerce sector bets is that obviously we're seeing an e-commerce sector bubble in India. Too much money has gone into the sector, and the sector adoption is not as fast. How do you read? Obviously, you made the Redbus investment in 2008. Now we are in 2016. What is your analysis of the B2C e-commerce sector in India?
That's a good question, and I think that there are, like any sector, there are attractive companies and there are challenging companies. I think that our thesis back then, you know, we looked at some of these other kind of horizontal e-commerce players that you've mentioned. They were taking inventory. We didn't like that. And they're subsidizing, and we're not in favor of that. It doesn't mean it can't work. Don't get me wrong, but for our fund size and for our strategy, it just didn't meet the filter that we have and that we stuck to, which is, hey, we want to see companies like Redbus that are enabling people to do something they otherwise couldn't and who are willing to pay for it. And so if you look at the Redbus story, for example, in e-commerce, they were charging about 8% commission to the bus operator for the seats they were filling when we first invested. By the time we sold the company, they were charging almost 11%. They had increased pricing, and everybody was very happy, including the bus operator, because the bus operator was getting more and more seats filled that otherwise would go vacant. So every incremental seat that they filled to that bus company was pure profit to that bus company. And so it was a very, very accretive model that everybody in the ecosystem, you know, enjoyed a benefit from. And that's what we're fundamentally looking for. And I think that in e-commerce, you know, so we for example, have then therefore had a thesis around services-based businesses in e-commerce for consumer. You know, financial technologies are a big segment there, right? So there's not a physical good that I'm handling at a high cost that has a shelf life that may, you know, spoil and have obsolescence or returns or all these other things. So whether it's insurance, so we invested in Policy Bazaar, which is the leading online insurance marketplace by a factor of 10 over its competition now. It was about the factor of 5 when we first invested, just accelerating away as it's gaining share, and again, getting increasing commissions from the insurance providers for selling through to the consumer in India. We're the lead investor in Funds India, which is the leading online mutual fund marketplace for consumers in India. It's just dramatically growing. And again, providing price discovery, understanding of these products so that you can stay away from the products with the high fees, the high loads, or in insurance where you cannot, you know, be taken advantage of with, you know, basically being sold annuities that never pay off compared to the premiums that are demanded. So there's a consumer benefit there. There's a benefit to the insurance agency as they have broader reach to the consumer, and there's a benefit to us and everybody shares in it. And so we look for those dynamics, and I think those dynamics are very present in the market today, but I think the headlines are going to the kind of horizontal players that have kind of, you know, taken the quote-unquote Amazon bet, you know, where Amazon, for example, in the United States had to basically subsidize its business for over a decade before it could establish dominance and pricing power. And that is where capital is a weapon. It's very capital intensive, and the last person to get the capital is going to win. Those are fine for large funds and, you know, funds that want to, you know, participate in that.
You can't play in that.
That's not what we want to do. It's not what we built our firm to do. But
it's also a very risky game to play for entrepreneurs, because at some point the capital may dry out and then you're left to holding the bucket, basically. We see a ton of companies in Silicon Valley also kind of running out of runway.
Yeah, I think that it's very interesting. The cycle here is very similar. You know, for the last 10 years we've been doing this, right? And it was kind of counter-cyclical. Silicon Valley's up and India was down, or India's up and Silicon Valley's going through a correction. The cycles were offset. But I think in this last right now, and in these last 18 months, they've been, you know, in parallel. And so they're both going through the same kind of valuation correction and burn rate correction. You know, I think it's very different than it was, you know, Conwell and I and Parag, you know, we all lived through the .com. And I would tell you that we don't think this is like that. You know, back then, the fundamental problem was more about like the tulip craze, right? There was no fundamental market of scale to justify what had happened. Here, I think that's quite different. I mean, the markets are clearly available at scale. You know, the Flipkarts, the Snap Deals, even our own companies, they're selling billions of dollars of goods and services. Consumers are spending at scale through these sites for these businesses. The question is, how do you value them? How do you build a business model around them that can be sustainable and have attractive profitability in our lifetime? Those are the fundamental issues that have kind of gotten out of whack that need to be, that are going through a correction here. But I do think that someone's going to win. These are winner-take-most markets, as they usually are. Someone's going to win. There might be two that actually, establish an oligopoly and maybe segment, into different product categories or regions.
Well, and Amazon itself is a player. Amazon is not going away. Amazon is going to be a major player. So this is not a market where Amazon is going to.
Yeah, that's right. They may be the one to win. They may be the one to win. They're certainly in the horse race, and all the anecdotes you hear is that they're nudging ahead currently. We'll see how there's always growth pains for any company, even the established ones, when they go into these new markets. So I don't know who's going to win, but I think someone will. And so I don't think it'll be like the .com where nobody won. There's very, very few companies that survived.
Well, the .com also people won. There were perhaps less visible companies. Well, first and foremost, Amazon won out of the .com. And then there were companies like Blue Nile that built very substantial companies, founded in 1999, built a $300, $400 million business over the, duration of their, the last 10 years or last 7 years.
Oh, yeah, so I'm just saying I don't think that back then there was just, you can count on one hand or a couple of hands the big winners, right, because so many didn't make it. I don't think it'll be as difficult a winnowing this time is what I'm trying to say. I think there's enough fundamental
the volume of the throughput is going to be much higher this time around, absolutely. So switching gears a little bit, on the B2B side, there are, we've talked to we work with a number of investors, especially investors like yourself who are small funds. By the way, we have an investment, we have a portfolio company that Parag funded called Avaz out of India.
Yeah.
It's, I introduced Ajit to Parag some years back, and it's a really very, very good entrepreneur. It's a very tricky segment, but it's a very good entrepreneur. But coming back to B2B, the trend that we are seeing is twofold. The VCs are kind of shying away from B2B SaaS or B2B technology that is facing the Indian market and moving more towards the global market. So if you're doing a B2B SaaS company, for example, then you are fundable if you work on the global opportunity. You're not fundable if you're working on the India-facing opportunity, is kind of the buzz that's percolating into the ecosystem. What is your fund's perspective on this?
Yeah. Well, I think it's a very practical issue of market size, and not just market size someday, but
adoption.
Well, that's true, but it's market size and market access, and we take a very specific view company by company, so we don't have a kind of a whitewash answer on this. It's not an either or. It's not either India or global. It's a bit of both. We look at these companies kind of fundamentally bottoms up, and for example, we've got a company, Power to SME, that is building a business-to-business marketplace that for India alone, only India, that is just on fire. It's scaling dramatically, and we're talking about hundreds of millions of dollars, thousands and thousands of crores of product moving through this company, and it's all in India. And it's all businesses buying from businesses. And so there's an example of where B2B works in India. And we have a fundamental view that that's emerging. Huh?
What is the name of the company?
Power to SME. So, they're providing a buying club to basically help small, medium enterprises in India access better pricing for the fundamental raw materials of their businesses, whether it's polymers or steel or cement, where they have to go and get just a terrible price per ton at a wholesaler, or try and go direct and get no respect from the manufacturers because they're just so small, right? But if they gang together through this digital marketplace and aggregate their orders, magic is happening. And so fundamentally our research there was, hey, the existing size of that market in India only is over $100 billion. $100 billion of cement and steel and polymers, all these different things that could be more efficient with the benefit of this company's technology. And that's a big enough market for a venture-backed startup, right? And they have price. They're getting a good gross margin. They're not having to subsidize. And, in fact, their margins are going up because, again, it's a virtual cycle. Everybody's enjoying a benefit, and so they're getting an increasing share of that benefit as they scale. But I think that the point about SaaS is all about market size. We have a different view. Most of the SaaS companies, and we've been doing SaaS companies since we started 10 years ago out of India. We've always had a thesis that business software companies were going to be very interesting product opportunities. And that came out of our own perspective of, hey, we don't have a geographic bias. We're going to invest in startups in Silicon Valley. We're going to invest in startups in India. And we do it out of a thesis-based approach. And we say which one is the best product, because these are global markets. And even business software that's addressing the Indian market ultimately is going to face competition from overseas, or they're going to have to go overseas. So they have to be able to you have to have a thesis that they can be number one. And so, for example, in MarTech, marketing technology, we made several investments in companies that were going after the Indian market at the time that we made the Series A investment, and didn't have any overseas operation. They kind of thought maybe someday they'd go overseas, but they were going after the Indian market, and we backed those entrepreneurs, and we're very pleased. I mean, they've now, scaled dramatically. They have gone outside India ultimately, but they've done it with a huge advantage of having a really well-perfected product as a result of serving the Indian business customer. And so that Indian business customer actually is oftentimes more demanding, more difficult to service than a U.S. or a Chinese or a Southeast Asian customer.
Well, it's good to validate in the local market and get your product right, and then go after the global opportunity. But I think you're kind of reinforcing what we are seeing in terms of trends, is that the Indian market is a slow growth market. The Indian SME market in particular, and the enterprise market also, these are slow growth markets and slow adoption curve markets. So eventually, to get fast growth, people have to, but the marketplace example that you gave is different when it comes to selling software or IT. Those have not been the fastest growing markets. We've done a few stories that are.
Cool. That's true. Yeah, Rama, you're right. I mean, in the rearview mirror, steering the ship in the rearview mirror, that's absolutely the case. I guess that we still believe, and we're beginning to see the glimmer of it, that Indian business, Indian industry will value technology over labor, and that's the key. Have to. And so looking for that, we're optimistic about that, and I think that some of that change is afoot. We're starting to see that some of these businesses are adopting software rather than just hiring a dozen more people to do it manually. And
I think in both the case of e-commerce and in the case of technology adoption by the B2B world, the enterprises and the SMEs in India, the trends are in the right direction. Those markets are going to accelerate. They have been slower for the last, decade, but they're accelerating and they will continue to accelerate. So there will come a point where it will become a lot more, viable to build Indian market-facing businesses even on the B2B side. So one last question before we
hope so.
Switch to the mentoring part. You said that you invest both in Silicon Valley and in India, and you started by saying you invest mostly in the Indian community. Now, our community is not just Indian. We have tons of, members from all over the world, all ethnicities and so forth. So do you only invest in the Indian entrepreneurs, or do you invest in other ethnicities as well?
Yeah, and thank you for asking that, because that's an important clarification. We have what we believe is a preferential and a very kind of mature deal network in the Indian community, and therefore a lot of our deal flow comes from that community, but we don't have that bias. So we've backed, Iranian entrepreneurs, we've backed, just plain old American entrepreneurs. Our agreement with our investors is we're going to expose them predominantly to an Indian opportunity, but not exclusively. And so, no, we don't have a bias to say that we have our, our eyes closed and our blinders on to anything but something with an Indian founder. The reality is that we think, we just find so many compelling business reasons. It has nothing to do with ethnicity. There's so many compelling business reasons. For example, we've got this company, Resolink, that's here in Silicon Valley, that's selling to General Motors and Delphi, multi-year large contracts for business software to manage their supply chains, and they just have a fundamental cost and business service advantage because they're doing it all out of Pune. So they've got 90% of the company in Pune. They've got the front-end sales and marketing and some architecture here in Silicon Valley, and they are just running circles around their Silicon Valley competitors because they have a fundamentally lower cost of doing business and really, really deep technology built by, a staff of over 100 engineers out of India. And you just couldn't do this company in Silicon Valley with any kind of capital efficiency today, but they can. Right. And so, again, here's a company that's taken less than $10 million in total in venture capital, and it's scaling dramatically because of that, and it's beating its competition. So that's what we look for, and whether it's, So
the bottom line is you're looking for capital efficiency. How entrepreneurs achieve that is up to them, and definitely using Indian engineering development centers is one of the ways that people are doing it. Absolutely.
Other companies they've got teams in Russia, right? We've got teams with, some really core engineering and big data talent and data scientists out of Russia. But I think that the message for us and for anybody that is listening is that, we are early stage investors, and we fundamentally believe that we need to be near our entrepreneurs and our teams, and near, physically close to our founding teams. And so, that means Silicon Valley and India and California and maybe some other parts of the U.S., but we don't tend to think about Europe. If people are domiciled elsewhere, it's not for us, not the right choice for that company.
Sure. Very good. Well, let's switch to the mentoring portion of the session. Folks, those of you who are going to be presenting today, just a little bit of expectation setting. John will be staying on for the rest of the session, and whatever we share with you here in terms of feedback is given with the intent of helping you. We have no other agenda here, okay? This is not Shark Tank. We are not trying to entertain people. This is a working session. We are trying to give you some feedback with which you can do something useful. You can accelerate your journey somehow or the other. And, it's hard. Entrepreneurship is hard, and just people who have seen a lot, done a lot of different things, and just have seen a lot of different strategies will be able to give you some shortcuts, and that's really what we are trying to achieve here is give you some of those shortcuts. And if you do disagree with the feedback you get here, that's okay. You don't have to, no one's forcing you to take any of this feedback and convert that into action. It's really up to you. It's your business, your strategy. You will decide what you want to do. So don't feel bad. It's okay. And then the other point I want to make is those of you who are in the room listening, and please do participate. Participate in public chat. Participate by calling in eventually, and when we open up the line, etc. So do line up your questions and do weigh in. We're going to start today with actually a 1M1M Premium member, Vasu Akula. Vasu has been in the program for quite a while, and I absolutely love Vasu's story, and we're going to do a catch-up session in the public roundtable today instead of the private, just because Vasu has achieved quite a lot, and he would like to share it with our larger community. What fascinated me, and I had a kind of like a hunch that this was going on, and Vasu's experience and the experiences of some of the other people that we've worked with have confirmed this for me, is that there's a methodology that we are using called bootstrapping using a paycheck. Bootstrapping is hard. The cash has to come from somewhere. So either you have personal savings, or you have a little bit of friends and family money, or you are, getting to customers very quickly. Whatever way, you're going to have to bootstrap your way to some degree of validation, get a product going, get some customers going, and so forth. And as you heard John say, and many others before John, that the investors tend to want companies that already have that level of validation. So, in Vasu's case, the methodology for bootstrapping that he has followed, he and his colleagues have followed, is bootstrapping with a paycheck, and it's worked out really well. So Vasu, welcome. It's great to have you here. Tell us what's going on. Give us an overview of your current situation and where can we add value.
Yeah, absolutely, Samana. It's been a while, but I have been, a passionate reader of all your emails and advices, and I'll echo what you just said, bootstrapping with paycheck, and then you have variations of that style of bootstrapping, right? Whether that is a service thing or some other way. And one thing I will never forget: customer money is the most valuable money than any other money, whether it is your personal money or investor money. So I kind of took it to heart when you said that 2-3 years ago. And I'll share a little story about, what we have been doing together with all your advice over the last couple of years. And then I have a couple of questions on now. It feels like we are close to that 1 million mark. Now, how do we really take it higher with the validation we could create so far? But first of all, wonderful to chat with you. Nice to see 300+ sessions and a lot of advice, and thank you so much for everything you do.
Absolute pleasure. So do you want me to advance the slides, Vasu?
Yeah, let's go to the next slide. This is, for, all other colleagues, I feel like, maybe I should share my story knowing that this is the public roundtable, and maybe, I could, give an example to someone else who is listening and, trying to figure out how to navigate some of these things. So my story is, I've been working with Ramana and the 1 million 1M1M program for the last 3.5 years. Certainly, I was contemplating, whether to quit my job in pursuit of, doing my own business and things like that. and there was a day, I sent an email to someone. Hope you remember that. It's probably you get a lot of emails like that, but the advice I got is, keep your job and invest that, kind of job money into whatever you're doing. Get your ideas stitched together, and then time will tell you when to quit that job. Right? So I kind of did exactly that. We were 2 people at that time, wanted to quit our job. One decided to quit. The other one kept the job somewhere in the middle of 2013. But we both, kind of kept our job, pretended as if we quit our job, so that gave us a little bit of cash cushion. Right? And then, a year later, we got, a couple of couple of ideas together. The idea has always been from day one, listen to customers, and there are various ways in which we can listen to customers. You can listen to customers in social media, you can listen to customers in emails, you can listen to customers by figuring out what they're doing on your website, you can listen to customers in call centers. So all of these are various, or you do a survey and listen to customers, right? So the idea for VOZIQ has always been VOZIQ, you kind of create intelligence out of voice, and that's our kind of, tried various ways in which, we can listen to customers. But in 2014, we kind of got to the point of, Ramana, probably, you've been kind of saying this with another style of bootstrapping called still don't quit your job, or just, take your, if you're working for a company called ABC, work for yourself, but still keep doing exactly what you do. It's called bootstrapping through surveys, because you have the talent and someone, is willing to pay the talent. Just switch yourself from an employer relationship to, get your paycheck on your business name, right? That's basically what we did in 2014. So I'm kind of, saying that bootstrapping with the surveys. And then, that time was enough for us to understand some of the challenges, and there was, a lot of lessons learned. And then we started last year, building whatever we are learning through surveys and all these things, built a product around it. I'll share some details on what we are doing. And now it feels like, okay, now we learned enough. It's a different problem, but there is, money in the bank, and now the challenge is about how to break through the 1 million barrier.
Good. All right. Let's talk about the business.
Yeah, the business is, I kind of told a little bit about, like, what do we do at VOZIQ and what's the real problem that we address. So the bigger problem that we address, or the umbrella problem that we address, is improving customer experience. And as we improve the customer experience, there are two things that will happen. One is you create happy customers, and as a result, you reduce customer churn. And also, as you kind of improve your customer experience, you are internally kind of improving your processes. That means you are also kind of lean and efficient in servicing your customers. And I'm talking about businesses that have million plus, 5 million plus, 10 million plus customers. So we sell into B2B companies that have, large customer bases. Think of your wireless telephone company, or think of your cable company, think of your insurance company. Those are the types of, companies that we work with. They all have, you can kind of take your, cell phone company today, or your cable company. They're generally bigger companies with millions of customers. And if you think of, how they handle this problem with customer churn, they acquire 10%, if you take a million customer company, they add 100,000 customers every year, and they keep leaking another 100,000 customers every year. So that's how they float. So every, small percentage change that they can make on customer churn is going to go straight into their bottom line and profitability, and, so many wonders can happen with customer retention. But the way the companies have been handling this is, it's always seen as a CMO problem. It's the marketing problem or the sales problem. And they kind of have a lot of data about, who this customer is, when did they sign up, for my package that I offered with, this discount, where they live, how much do they pay, what's their demographic, structure, how much they make. Based on all these things, they create, typical churn signals or churn scores, and that results in, maybe generating some offers. Sometimes you might get an offer through an email. Sometimes you might get it to your home, a printed card, all of that. But the problem with this approach, which works, but there are better ways of doing this. One of the problems with this approach is it's a little reactive. By the time I decide to switch my cable company, I probably have already decided what's my other cable company, and in many cases I probably have already installed it. Same thing happens with your cell phone, right? By the time you cancel phone 1, you have phone 2 in your hand, and then you call them and cancel, right? So it creates a, even if we kind of look at the, block number 2, I'm calling this a reactive approach, because when it is the day for me to cancel, I raise my hand, I call into this call center and say, I want to cancel. Then they throw a lot of money at you. Hey, I'll give you 3 months free, and this upgrade free, take this equipment free, all these things. But it doesn't matter what they do. I already made my decision yesterday, right? So it creates all these irreversible outcomes, and creates loyalty problem, and as a result, companies are suffering with churn problem, right? And they throw a lot of money at this thing. And if we flip to the next slide, please, Samana. Oh, this is not aligned properly, but I'll explain it. So the way we do it is when customers have issues, let's read it from the left side. The customer with an issue is calling into the call center, and the bottom person is the call center customer service agent. So they kind of understand the customer challenge, and then they're required to take notes at the end of the call. Samana called and she complained about cable quality being poor, or the package kind of being expensive than what was told, right? Or sometimes she might even say, hey, I'm just shopping around, and this company B is giving me this rate, can you match it? Or you might even call into the call center and you say, when is my contract expiring? That service agent may not get the signal, but why would you say, when is my contract expiring, right? Or why would you compare, this company with the competition? Or why would you complain? All of these are things that, if we know ahead of time, and if the agent is skilled enough, they can do certain things. And by the way, the same exact information is available for that call center agent that is available to our CMO, right? So now our approach is you combine both of these things, the feelings and the needs and the wants of the customer, expressed on a very, very large scale. When you're talking about million customers, compare this with the alternative of understanding customers through surveys. You can send out, thousands of surveys, you get 3–4% take rate. But when you look at a, million, 5 million, 10 million, customer call center, where thousands of people are listening to customer issues every single day and take time to notate all these things, they translate into tens of thousands of notations about what's working and what's not working for each company, right? So we use all of that, what we call transactional data plus the kind of unstructured side of it, which is interaction data. Customers are interacting with agents. We combine all of that and kind of make better models than what marketing has been traditionally doing. And the beauty of this is, I cannot change a FICO score of a customer, or I cannot change where the customer is living. I cannot change the age of the customer. That goes into these models, but I can certainly change the feelings of the customer. I can certainly, react soon enough if I know that this customer is rate shopping someplace else, and I can help the customer understand why I'm better than the other guy, right? So that's what happens. You get the same churn signal that a typical CMO yesterday has been getting, but then we add a layer of feelings and emotions, and more than anything, reversibility on the churn problem, right? And then there's a little bit of product that you see on the right side. So all of that kind of translated into our year 2 with bootstrapping as a service to year 3, which is bootstrapping as a product, which we are right now doing, right? So we can flip to the next slide, Shamna. So this is what we call our platform is. And all of this is based on, talking to a lot of customers and figuring out like how do you do this, better and cheaper and faster than many of the established companies which happen to do this in-house, right? Because there is heavy data involvement. So the difference with us is at the bottom, I have this box that says data sources. I apologize, this is not aligning pretty well, but the way to read that is, the bottom box is customer data, right? You see call center notes and surveys and IVR logs and field service, if people are coming to your home to install your cable box, those types of, on-field activities. And the right side, which is our CMO's good data source, billing info and customer profile, who is this and how much they pay, right? But we add all this softer side to the left side. What happened, how many times we visited this customer, right, to fix what type of problem. When they call into this IVR, which button did they press? Is it a tech support button or is it a schedule an appointment button, or is it like a make my payment button, right? All of that is unstructured, complicated, untapped information. So we kind of marry all of, we ask for feeds of all of this. But then if you see the box above that, there's a little thing AWS on the left side. All of that is our software. It runs in the Amazon cloud. And then what we do inside that box is our secret sauce, right? We try to understand journey mapping. Is this a new customer, tenured customer, close to contract, just acquired a contract. All of that gives us, some base level of new customers may have different problems and tenured customers may have different problems, right? The way you want to interact with them and, offer to them is different, right? And because we stitch all these things, we also understand customer intent. What is this customer trying to do? Buy more or save more, right? Or, get, fancier features or, base features. How much effort is this customer putting into solving his problem? Did he call 3 times or 25 times? When he called, did he talk 5 minutes or, 35 minutes, right? And sentiment, is he happy, doing all of this or not, right? So all of this is coming from unstructured side that adds a flavor to the right side information, billing and customer profile, right? So
Vasu, in the interest of time, we're going to have to work with other people as well. So I'd like to fast forward to your business issues, and in particular, let me ask you a few things that are that we need to understand. You've gone through, and I've kind of worked with you through the years. You've gone through experimenting with whom are you selling to and so forth from a positioning point of view. What is your current positioning? Who is the customer? Who is the buyer within the customer's account? You've talked about CMO. You've talked about customer service. Where exactly are you selling this product? And is there any other signal, vertical signal, or any other positioning point that you've come up with?
Yeah. So with all these conversations, this is the slide, Shramana, and this is the kind of discussion that I would love to have and hear your opinion today on this one. So focus obviously has been from day one US, but we are talking about subscription customers who have, the problem that I explained earlier. And they need to be big enough because, we are talking about, a couple of PhDs and IITs and IM caliber as part of the team that we have managed to assemble so far. So the verticals that we chose are telecom, cable, internet, banking, insurance, healthcare. Left side is more important than right side, but they all have, if customers are not happy, they have plenty of choices and they'll switch, right? So we specifically look for, a business with a call center with at least 100 agents to 1,000 agents. Bigger ones are kind of very difficult to get into for our stage. Not that the product has a problem, it's just the, current situation in terms of, capability to engage in long sales cycles and things like that. Anything smaller than that is not our target. They have different problems, different maturity levels, all these things. Or the alternative is they have enough number of calls on the scale of
So Vasu, have you analyzed the competitive landscape in each of these segments, the verticals that you're positioning, that you're pointing out here, in the sweet spot from a size point of view? Have you evaluated the competitive landscape in each of them?
Yeah, we did to some extent, Shramana. Maybe I need to go back and redo the, all of that. There are many companies that are positioned, and we do have differentiation, especially with text analytics. There is a differentiation, and also the approach in which we kind of, deliver this value to them, just because we don't sell the product and say bye-bye, have fun with it. This problem is just not going to work like that. I think those are kind of some of the differences. The other companies are in kind of all on-premise implementations mostly. We're doing this in the cloud. That gives us some advantage.
No, that's not true. That's not true.
Okay.
I've actually, if you look in the case studies in the curriculum, there are case studies of people who are doing exactly this. So look in the thought leaders in big data series, thought leaders in cloud computing series, and you'll find other companies that we have covered that have this as their value proposition of, mitigating churn. So mitigating churn in telecom is something that I've seen before. Off the top of my head, I don't remember all the names of the companies, but if you start looking in the case studies, and especially in thought leaders in big data, I think you will find other companies that are focusing on this.
Okay, sure, yeah. But I think, I might need to go back and kind of redo the exercise one more time.
You need to do the exercise. Now that you have a better idea about what you are doing, where you're getting traction, now we need to do a positioning exercise on this. Let me get John's feedback on your company. John, would you please weigh in on what your thoughts are on what you've heard so far?
We've seen a number of companies trying to address churn in e-commerce, in SaaS software, as you mentioned, in telecom over the years. It's been a challenge. We often find that, particularly in SaaS, that some of the customers think they can do it themselves. They want to do a homegrown solution. So we've seen a kind of a slow matriculation in the conversions. I'd be interested in your own sense of what the sales cycle's been and whether you're seeing increased interest in velocity or not in the customers you've been talking with and the segments you're going after.
Yeah, that's one of the challenges we have, John, and precisely like what you just mentioned. They want to do it in-house, but they don't have the talent of dealing with unstructured data and predictive analytics and bigger data, right? So inherently, after fighting with it for a few months, then they're kind of looking towards these vendors. And then 55 different styles of implementation, and being close to India, the point you made earlier, fundamentally different cost structure. So our team is also kind of based on India. So we are trying to bring those differences to create a compelling model. Don't hire an analyst, pay $150K. For that same $150K, you'll get a product and you'll get a better implementation, better measurable result, because that's the kind of cost, the solution cost that we are talking about here. 1 to 2 analysts is going to get you 1 to 2 analysts, by the way, plus some technology. But the sales cycles are 3-6 months because they have to go through their own cycle of this. Everyone is saying we did like a lot of presentations last year. Everyone has been saying agree on the problem. Definitely, I have this problem. Now, which way am I going to go to solve this problem? Is it in-house or outsourced, or I already have a relationship with this particular vendor in call center. They seem to be doing it, but all of those are variations. So, Samna, if you ask me, I think we need to kind of get our story a little more inspiring than how we are telling, probably, and then kind of let the ROI equation stand out clearly.
Yes. And so, Vasu, let's do this. We have a private roundtable next week. If you could come back there with more of the competition analyzed, we can do the positioning work. And I think if you can find a segment where there is more of a gap and your differentiation echoes better, then we can align with that segment and create a strategy, basically a scaling strategy within that segment. And as you know, from your work with us and from the methodology that you've learned through the program, that always works, Rather than trying to go after 5 different segments, if you can really build differentiated expertise and buzz, right, then the buzz also you would create within that segment with a very systematic strategic effort, that always works. So if you could do the comparative research, and then I will work with you next week to do the positioning work, that will be one of the sales accelerators as well. And then you can accordingly decide whom to hire, or if you want to bring on a third co-founder, to look for somebody from that background, right? Whatever vertical you decide to go after, maybe somebody with a sales background in that vertical, etc.
Yeah, okay. Let me do that. I think, we have kind of crossed our, certain validation stage. Now it's the challenge of, maneuvering this, difficult B2B technology, 6-figure plus types of deals with a small team. That's our challenge. So I'll come back with maybe, now that, we have the background and everything, Samna, we'll take exact same questions. Maybe we'll put it in a different session and talk through that.
Right, and there is two other points I want to make. You know how we you have used before, but in this presentation you did not use it. We have templates of presentation. So part of this, making the story more exciting is to make the presentation more exciting. So there's a customer presentation template in the curriculum that you should be using, which gives you the framework of how to make your story or pitch more exciting. So I would like you to start using that and kind of fill that in, because there's things missing. As you said, the ROI story is not fleshed out fully, at least not in this presentation. So use that customer pitch template and get all those pieces in place so that it like pops much more. Right now, you're pointing out yourself, it's not sounding as exciting, but if you can make it sound very exciting, if you can show real customer metrics and ROI metrics.
Yeah, I'll say that's the challenge, Shamna. Being a delivery person, I talk about problems, much more quickly than kind of amplifying the thing, and that's where I'm kind of, the other co-founder is a technology person. I'm more of a delivery analytical person. It feels like, we're missing.
Yeah, but Vasu, you've learned all these things. You can learn how to present.
All right. Okay. Sure.
You've done.
Wonderful chatting with you. Yeah.
You spend all this time in learning so many things. There's a few more things to learn. You will learn. Big deal.
Yeah. I'm confident in all these things, but it's just the time that goes into delivering whatever commitments we have. Right now we are challenged with that, but let me take it offline. Come back into your private roundtable, maybe
Sure.
2 weeks, 3 weeks from now, and then we'll try to see how to sketch the path for the next 1 or 2 years.
Okay, sounds good.
Wonderful.
Okay,
Thank
we
you
have
so much.
Alex. You're very welcome, Vasu. Alex Genadinik is next from New York. Alex, would you unmute your line, please? Go on. Alex?
Yeah, can you hear me now?
Yes, we can hear you now.
Okay, so I'm going to apologize in advance because I'm just getting over a cold, and I think at some point I might cough, and hopefully I'm okay to understand. And if I'm not, let me know. So I guess I'll start. My business is Problemio.com. It's a name that nobody really understands. The idea behind it was, the traditional business question of like, what problem is your business solving, right? So hence Problemio. But I think everybody else misunderstands it as that Arnold Schwarzenegger line of like, no problemo. But anyway, so the idea behind this business was that because I'm a software engineer originally, and all my ideas that I ever tried when I was younger, they failed because I had no mentoring, didn't know business, and I realized really early on that if only somebody was there to help me, somebody with experience in 5 or 10 minutes of conversation, they could have like steered me away from some of my mistakes that I was making and onto like a more successful path, and I just wanted to build something like that for others. Maybe we can go to the next slide. Right, so what I ended up making was a lot of tools and educational material for entrepreneurs to help them through every part of the process of starting their business, from the very ideation to very advanced marketing strategies. And this is actually not where the business is today, but I just wanted to give a little overview of, sort of how it started. So maybe we can go to the next slide. So yeah, this business has under it, the consumer-facing business of this is a self-branded business where I'm like the expert. And I started with some successful mobile apps for entrepreneurs, on Android. My app is ranked #1 for the Churn business for like the last 3 years. I've got a large YouTube channel. I've written over 20, actually exactly 20 business books, business and marketing. And I have 80 courses, online business and marketing courses, mostly to my name. Also because of all of this, a lot of people come to me for coaching. over time, I've, in some capacity or another, coached over 2,000 people, but in different capacities. Some people very briefly. And of course, where the business is going on the B2B side is content licensing and content production. Next slide, please. Right, so I kind of mentioned when I was younger, this is exactly what I needed, so I built it for others. So actually, already talked about this slide, so let's go to the next slide. Right, and just a little bit of how I got here. On the apps were the first thing that I built, and there was one feature on the apps that I allowed anyone to ask me questions, and I would spend time chatting with them about their business issues and what kind of questions they had and everything. And basically, kind of like, this was my way of listening to the customer, right? I basically just, they told me their issues exactly. And it wasn't in the feedback form, which, you know, people rarely give feedback, but this was in a passionate form where they really were like, I need help, I'm struggling, this is exactly my problem, can you help me? And of course, a lot of conversations kept repeating. In fact, a few conversations are extremely common. I almost felt like I was in an insane asylum because even though entrepreneurs, they all feel like their situation is so unique, they really didn't realize that they're actually almost carbon copies of one another in large parts of the process, right? Like, they all ask about raising money, they all struggle with like starting, planning, and then very few of them actually end up moving on and needing marketing, but then they all struggle with the marketing in exactly the same ways. You know, they say like, you know, when they're first-time entrepreneurs, they almost unequivocally say, I'm going to promote my business on Facebook, Twitter, business cards, and flyers, right? So they need a professional marketing strategy, stuff like that. So when, thank you, by the way, for going to the next slide. So when there were something like 300,000 people who had used the apps, I took all of their questions that ever got posted on the apps, kind of organized the questions, and answered them in what became my first book. And books are fine, you know, but of course, you know, and then that was a book on starting a business, and because I did so much research, my feeling was that it was the most comprehensive book on literally how to start a business, because it really answered every question from such a large sample set of real people all around the world. And of course, that book was accompanied by another book on how to reach 1 million people, you know, a marketing book. And of course and then because of that time, I had reached somewhat of a notoriety in the mobile app space. I also wrote the mobile app business book, which was like, actually today, probably the #1 book for, if you know, mobile app business, mobile app marketing, mobile app monetization, probably that's like the go-to book. And blah, 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 you know, fast forward, I've got 20 books on, you know, similar topics, marketing, various business niches, things like that, business planning, marketing planning. I think, go back one slide. Yeah, so it's still there. So, and then, but the books are fine, but, you know, reading is down year by year. So people were continuously asking me to get into video, you know, to explain the same things in video. So I got into YouTube, which was really new for me because I had never made videos before, and it took me a while to become comfortable and reasonable on video. But once I did, I got into premium video instruction, which is Udemy. That's basically video commerce, right? It's like e-learning, but it's at the same time e-commerce, which is great. Let's go to the next slide. Yeah, thank you. And Udemy has really grown my business. You know, I think today my consumer-facing business is everything that I've mentioned before: apps, YouTube, coaching, books, all that is great. But Udemy is double than all of that combined because it's, you know, it's very direct, it's commerce, and it's digital goods, so it's 20% profit on sell ebooks as a digital good, but that can't sell that for too high of a price. So that's what the courses really allow, is that they give like a mid-price digital good, and it's e-learning and e-commerce at the same time, which is great. It's direct revenue, and today it makes up a large chunk of my consumer business. And obviously I have 80 courses, so and I'm adding new courses to my library every month, sometimes multiple. And next slide was that. And what ended up happening is after I gained a little bit of I don't know if notoriety is the right word, but some prominence in the e-learning world, people started approaching me for licensing their courses, having content made specifically for them, like, that would not be licensed for them, but owned by them, and would only be owned by them. And that started my B2B side of my business, which is actually quite recent. And it's where I said that Udemy makes up twice everything else I do on the consumer-facing side. The B2B thing makes it like almost quadruple the consumer-facing side in a very short amount of time, which is like very surprising. So yeah, and really that's really it. It's creating custom content or selling stuff from my existing library of, I have 100 titles, right, 20 books, 80 courses, and I continue to make courses. I kind of perfected me creating content on my own. Just right now I make it very fast, high quality. It's almost entirely.
So Alex, what brings you here?
Actually, I thought it was a good forum to, get feedback, show my business.
But do you have questions? We are supposed to, if you take a slot in the roundtable, you're supposed to ask questions. So what is your question?
So at the moment I'm exploring this B2B world, which is admittedly new for me. Luckily, people have come to me with demand, but I'm only now starting to reach out to companies. And I guess my question would be not so much how to reach out to companies, but how to identify maybe which companies might be a good fit for this, so that I don't randomly identify, so that I don't randomly approach them. Or how would you develop a sales structure for, it's clear what my products are and what my services are, right? It's basically licensing existing stuff, making new stuff, content, and it's content that they can sell to their existing customers or, something like that. So that'll be more, that's the products and services I would sell to these B2B companies. And I guess any advice on the process overall?
So what is your hypothesis about the kinds of companies that want you to create custom, business education content for them?
So far,
the business you're proposing to build is predicated upon there being a universe of companies who want you to create content for them or want to license your content that you've already created. So what is your hypothesis about that segment of companies?
So there are a couple
John, would you, one second, Alex. John, would you like to weigh in? I'm just giving him my questions. If you have a question or feedback, please also weigh in.
Well, yeah, if I get it correctly, you're trying to provide a curated application of content for entrepreneurs, and if that's the case, I agree with this, the predicate question, which is, what has encouraged you to do that? What kind of approbation are you seeing? Are people, you have any, I don't know where you stand in the journey here. Do you have any traction? Are you delivering this now? Are you getting feedback from the market?
Yes. So, I mean, where do I start? So, I think the time thing that I see that unifies these companies, a few things, is a lot of them are already in some capacity in online learning, online training. They just don't have the video library, right, like that I have. So that's one thing, right? So they can easily, instead of making their own and spending a lot of money, they can in one day buy mine and boom, they're in business, whereas otherwise it would take them months. So that's one thing.
So that should answer your question on one category, one segment of companies that you need to go look for and find all these companies who are online learning companies who do not have an entrepreneurship curriculum, and you can go pitch them your entrepreneurship curriculum and see if you can sell them your curriculum.
Partially the problem with those guys is the reason they don't have a library is that they are a little new and not wealthy, right? So it's rare that you see the problem here, because if they're just starting out, they're just starting out, and that's the problem. It's rare that they can afford a lot. Similar with selling to one-person businesses, right? They can buy the stuff, but not for a very exciting price. And part of the other unifying thing, maybe not unifying thing, but the other part of like the customer base that I have so far for this is agencies, sort of like marketing agencies who have bigger clients or bigger brands, and they need content, and they need to outsource the creation of this content. I think that might be a better client for me and more of a long-term.
I have to agree with you. I think that might be a better place for you, because licensing your content, I'm not sure if you're going to get a lot of traction with that for various reasons. I think if you're, able to convince people based on the content that you already have that you can create good content for them. You're right that there are many brands that are looking for good content as part of their content marketing strategies, and if you can convince them that you are the person who would create good content for them, that may be one way to go about it, but you have to validate it. You have to validate whether you can, convince brands to go that route. But I think your content creation strategy is likely to be more successful than content licensing strategy.
Yeah, except, so in terms of traction for this, we are like in May 12th, I think, and I'm like in $30,000 of revenue from the licensing this month, right? So it's the traction, and it's all profit because the content is already been created.
That's good then. That's actually what you're saying is good revenue. So why not pursue that line and see what you can do?
I am actually pursuing it. That's just my answer to the question of what the traction is like. Okay.
Great. All right. Well, Alex, good luck with your project, and we need to move on. We have a little bit of time left, and we have some other business to cover. So good luck with both your strategies, and see which one gets more traction.
Thanks.
Folks, I'm going to explain to you a little bit about how to use 1 million by 1 million. And if you like what we're doing, please bring serious entrepreneurs to the program. Building a business is very complicated and time-consuming stuff. It takes years of work to get something off the ground and build something to substantial scale. And that requires people who have a clear understanding that it is going to be a multi-year journey and a lot of work. So that's the kind of entrepreneurs we are looking to work with. In terms of resources, everything is at 1mby1m.com. And you will find a blog that is rich with educational and inspirational material. You'll find the Entrepreneur Journeys book series as a very reasonable entry point to the program. There are 12 volumes, all focused on technology entrepreneurship and double-clicking down on each of the different topics. And today, Vasu discussed bootstrapping with a paycheck and bootstrapping using services as two ways that he has used, two methodologies that he has leveraged to get himself going and to a point where he is approaching $1 million in revenue. So these are, nuggets and nuances of strategy that you would learn from these books. Each of them are case study based, so there are essentially 12 to 16 successful entrepreneurs who are teaching you their methodologies through these books. And we follow exactly that same principle in the 1M1M premium curriculum and the basic curriculum as well, which is a video lectures and case study based curriculum where we have over 700 successful entrepreneurs teaching you their strategies, sharing their journeys, and so forth. So you're not learning just from the 1M1M team or just from me, you're learning from over 700 successful entrepreneurs. There's tons of material on the website. You can dig around and see if this is the program that you want to use to learn going forward. These roundtables happen almost every Thursday. We have one more left in May, after which I'm traveling for a few weeks, so we'll resume in June. But next week's one is still open, and you're welcome to come for that one. The 1M1M Premium program is an annual membership program where you get extensive methodology guidance. We have private versions of these roundtables. We have over 300 hours worth of curriculum, and that's video lectures and case study based, which is where you get to learn from over 700 entrepreneurs. And then we do help you with financing, we do help you with media relations and get the word out there. So all that is part of the premium program. That is a $1,000 annual membership fee. You can go to the $1 Million Club on the website to see case studies of the program. And quantifying the 1M1M value equation, what we do is essentially we offer you value across multiple different vectors. We offer you here $375,000 plus 5 to 10% equity worth of value for just $1,000 annual membership fee. And that's, our efforts to democratize entrepreneurship education and acceleration at scale, essentially, and globally. So we're trying to make the tribal knowledge that is accumulated in Silicon Valley and at the heads of a small number of successful entrepreneurs, we're trying to make it as accessible and as democratically accessible all over the world. The self-assessment is something that you should all put yourself through. It's a set of questions that you would need to ask yourselves to gauge where are the gaps in your strategy. And it's available for free on the website. Please go ahead and use it as much as you want to. And in the process, if you see that you have gaps in terms of methodology, you can do the 1M1M basic curriculum only program. That is a $99 a month program, and that is available for all of you to just get started, at a very reasonable price point. If you can budget a lot of time in 1 month, you can do a lot of the curriculum, let's say 50 hours of the curriculum in just 1 month, or maybe 100 hours of the curriculum just in 1 month, and I'm sure you will learn a lot through just that. So we're trying to offer you mechanisms for learning at various different points. There's free, there's books, there's video lectures, case studies, all kinds of things, and you're welcome to use whichever one of those that works for you. That's fine with us. Okay, so dig around on the website and see what questions you have. There are lots of FAQs, video FAQs. We want you to make your own decision whether this program is for you. This may not be for you because this is a self-learning oriented program. You're going to need to do a lot of your own learning, and if that's not your mode of learning, then this is not going to work for you. that's, those are the things that I want to tell you about the program itself. Our methodology is lean, capital efficient, bootstrap startups, and where you raise capital, we want you to raise small amounts of capital and make money. There's no benefit to raising huge amounts of money and then get buried in liquidation preferences and ending up with no money at all. This stuff is quite complicated. So we will teach you, we'll walk you through all of that and help you learn all of those pieces. That's pretty much all I want to share with you. There's a lot of media coverage that we can provide you with through our various channels. Take advantage of that as well. If you're building an entrepreneurship ecosystem somewhere, you can use the one-on-one affiliate program to partner with us. Our upcoming free roundtables are May 19th, one more in May, and then June 9th, 16th, 23rd, and 30th. So there are 4 roundtables in June. That's pretty much it. If you have any questions, now is a great time to ask. So you can either call in or ask questions in public chat. Either way is fine. Now, even though we are past 9:30, which is when we normally stop, I would like to take a few minutes to take your questions if you have any. And I see that many of you have introduced yourselves. Viron Chrysovergis from Greece is here. Sanjay Patni, you're sending me a private message. Yesterday at the Oracle Private Roundtable, I pitched Aura Acid. We do not have this internally for Fusion apps. Would it be appropriate to validate concept by doing a POC with bare minimal functionality for Fusion apps? I can propose this to Oracle mentor assigned to me and get started while looking at 1M curriculum in next 3 months. Sanjay, you should not be doing any prototyping until you get a clear business case validation through your work with the 1M methodology. So please make sure that you don't go into prototyping anytime soon. Anybody else? Any other questions? You can ask questions in public chat or you can call in, whichever suits you is fine. Let me also introduce you to Irina Patterson, who would answer questions on the premium program or on the basic program, whichever one you are evaluating. She'll be happy to answer your questions. Her email ID is irina@1mby1m.com. And thank you, John, for participating in the program today. It's great to have you. Anybody, any questions before we adjourn for today? Go ahead, Adarsh. Go ahead and ask your question. How do you solve the chicken and egg problem in a marketplace? It depends on the marketplace. There are, like the marketplace scenario that John was describing earlier about Redbus. In the case of Redbus, the case study, by the way, is available on our blog. You can look at it. In that case, the company went and did a lot of stuff for free for the bus operators and then brought the consumers onto the platform. They did all this software for free for the bus operators, which encouraged them to start bringing consumers, attracting consumers, putting their inventory online and then attracting consumers. So there, in each type of business, there is a different strategy for solving the chicken and egg problem. So we have to look at the dynamics of your business to be able to advise you. You're welcome to pitch at one of the upcoming sessions and we can discuss it in more detail. Well, pricing is a whole big topic. I can't teach you pricing in a in a nanosecond here now. Go to the 1M basic and do the pricing curriculum. There's a whole curriculum on pricing. Anybody else?
Shamana, this is Irina. Can I ask a common question that's asked by many entrepreneurs?
Sure.
And the question is this. Many entrepreneurs are asking me in their communications, how do I get a personal meeting with a Silicon Valley executive or VC in Silicon Valley?
Well, there's two different points. I think getting a meeting with a Silicon Valley executive is a different question than getting a meeting with a VC. To get a meeting with a VC, you're going to need to get introduced by somebody whom that VC trusts and whose recommendation is going to carry some weight. And also you have to meet the criteria of what that VC is looking for. So typically, people who have these VC relationships will only introduce you if you meet a certain set of criteria. So if you go through 1 million by 1 million, we have our set of venture capital relationships, and there, you will need to meet the criteria that we require for introductions to VCs, and then each VC has a different criteria. So we know these people, we know their criteria, and we will introduce you to the people whose criteria you meet. So that's how a VC introductions work, and then it's up to the VC whether they want to take the meeting or not, and that's the methodology. When it comes to executives, again, the same thing is you have to be recommended by somebody whom they know based on what they think is the synergy. People, if you just tell people that I want to meet you and shoot the breeze, people are very busy. No one's going to take that meeting. Okay, folks, sounds like that's pretty much it for today, and I think we're going to adjourn. Do come back next week before we take a break for I'm going to be traveling for a bit, and then we'll be back in June. So hope to see you either next week or in June. And let Maureen know who wants to pitch and who wants to book a slot, etc. And that's pretty much it. Thank you very much. Thanks for coming.